Interest rate hikes do not arrive with explosions. They move quietly, like cold air seeping through the cracks of Canada's economy. Each increase by the central bank may look small on paper, but behind it sit millions of loan contracts under pressure. Small businesses feel cash flow tighten, homeowners watch monthly payments swell, and financial markets begin to show signs of strain. Exchange rates fluctuate, liquidity thins, real estate slows. On the surface, life goes on as usual. Shops stay open, offices remain lit. Yet beneath that calm, the rising cost of capital is quietly killing something more important than growth. High interest rates are not only about fighting inflation. They redistribute risk, deciding who survives and who is pushed out. The real question is no longer how long rates stay high, but what Canada's economy loses before policy reaches its goal. Signs of crises rarely appear as sudden collapse. In Canada, they surface through numbers that seem technical: falling real estate transactions, rising housing inventory, widening CDS spreads on highly leveraged companies. Banks tighten credit standards, not because money is scarce, but because risk feels closer. Liquidity in corporate bond markets grows thinner, and real borrowing costs exceed headline rates. Workers may not lose jobs immediately, but hours are cut, bonuses disappear. Middle-income households begin to hit debt ceilings as income fails to keep pace with interest expenses. This is not a panic-driven crisis, but a slow erosion, weakening consumer confidence, delayed investment, and an economy shifting into defensive mode. History shows that when these signals align, the real shock often comes later and hits harder. To understand why high interest rates cause such deep damage, one must look at the mechanics of the shock. As rates rise, the cost of capital becomes the first barrier. Debt-dependent businesses postpone expansion and cancel long-term investments. Central banks drain liquidity from the system, making every dollar more expensive. The currency may strengthen briefly, but at the cost of weaker exports and squeezed corporate margins. In financial markets, asset valuations adjust to higher discount rates, stripping support from equities and real estate. More critically, high rates break expectations. When households and firms believe the future is riskier, they stop spending and invest in. The shock is not the rate itself, but the chain reaction spreading through a system where confidence gives way to caution. Global economic history shows that high interest rates are rarely a purely domestic issue. In 1997, IMF-led tightening across Asia pushed rates sharply higher, crushing businesses and triggering currency and banking collapses. Argentina repeatedly fell into similar traps, using high rates to defend the peso, only to endure prolonged recessions and social breakdown. Greece accepted brutal borrowing costs after its debt crisis, leaving an entire generation without opportunity. Turkey and Venezuela revealed two extremes: politicized rates or artificially suppressed ones, both ending in inflation and currency collapse. Canada differs structurally, but the lesson is shared. When the cost of money exceeds the real economy's capacity to absorb it, social damage far outweighs the original policy intent. In Canada, the fastest transmission of high interest rates runs through housing and household debt. An economy so deeply tied to real estate cannot escape when mortgage rates double in a short period. Home prices adjust, but debt does not disappear. Millions of variable-rate mortgages reset, forcing households to cut spending. Construction firms scale back projects, temporary workers vanish, and local supply chains weaken. The Canadian dollar faces pressure as global rate differentials shift, making imports more expensive. In capital markets, rising CD spreads on real estate and retail firms reflect mounting stress. Canada is not facing a sudden crash, but a state of congestion. Capital exists but refuses to flow. Demand exists but can no longer pay. This is the cost of high rates in a debt-driven economy. Government and central bank responses unfold in constant tension. On one side lies the need to control inflation and protect monetary credibility. On the other, the risk of choking growth and exposing financial fragility. Rates are held high, long enough to break demand, while fiscal support remains narrowly targeted to avoid reigniting inflation. Policymakers closely watch interbank liquidity, financial CDS indicators, and bond market resilience. Official messaging stresses stability, yet the tone grows increasingly cautious. This reflects the central bank's familiar fear: ease too early and inflation returns. Tighten too long and the real economy suffers lasting damage. Canada is walking a thin line between these two risks. When monetary policy turns harsh, its final impact always lands on personal lives. Workers may never read CDS reports, but they feel pressured through rent, credit card bills, and job insecurity. Small business owners choose between layoffs and zero profit. Middle-class families delay having children, delay buying homes, delay ordinary plans. High interest rates reshape social behavior. Defensive saving replaces consumption. Short-term safety overtakes long-term vision. Wealth gaps widen as those with assets and liquidity endure better than those living paycheck to paycheck.
What
is being killed is not just growth, but the sense of stability, the invisible foundation that allows people to take risks, innovate, and build a future. Yet history also shows that high interest rates do not destroy everything. They force adaptation. Survival in this environment is not about predicting rate peaks, but about managing risk. Lower leverage, higher liquidity, and longer debt maturities become essential. For workers, flexible skills and the ability to shift industries matter more than nominal wages. Investors learn to accept lower returns in exchange for safety. When capital is expensive, cautious decisions today preserve opportunity tomorrow. High rates expose the fragility of debt-based growth models, but they also create a harsh filter where only resilient structures remain. This lesson repeats across every economic cycle. Seen more broadly, high interest rates are quietly reshaping Canada's economy. As capital grows expensive, investment decisions shift from expansion to efficiency. Businesses are pushed to raise productivity instead of relying on cheap debt. The labor market loses the excesses of the easy money era, replaced by higher demands for skill and output. Housing gradually returns to its role as shelter rather than speculation, though the transition is painful. Over the long term, high rates may correct distortions built over years, but only if society can bear the cost of adjustment. The key question is whether Canada has the time and patience to transform, or whether short-term damage will leave lasting scars on growth and trust. In the end, high interest rates are not a single villain, but a mirror reflecting past choices. An economy built on cheap debt will always suffer when money becomes costly. Canada now faces a defining moment: accept short-term pain to rebalance, or delay and shift risk into the future. What is truly at stake is not only growth or asset prices, but confidence that the system can still offer fair opportunity to the many. When rates eventually fall, the lasting question will not be how long Canadians endured, but whether the economy emerged stronger or merely survived another brutal tightening cycle.